Bank of America, one of the worst performing bank stocks this year, down about 17%. Let's talk about all of this. Joining me now, fresh off the earnings call, is Bank of America's chairman and CEO, Brian Moynihan. Welcome back, Brian. Good to see you.
It's good to be here. Thank you for having me.
So on the quarter, the highlight is 10% rise in profits thanks to net interest income and net interest margin, and you raised that forecast on NII. How sustainable is this kind of growth?
Well, it's sustainable because we have 200,000 teammates who go to work every day and do a great job for our customers and clients. And so what drives our net interest income is our deposit base, which is the best in the business. And you're seeing the stability and growth in the commercial side of the house. You're seeing stability in the wealth management side. In the consumer business, consumers still spend down, but very stable, very profitable customer base. And so as you think about that, that goes. Loan growth this quarter was slow. We expect that to pick up as the rate cycle normalizes. And that led us to say that we had more NII this quarter, third quarter, than we thought we'd have back a few months ago. We held a $14 billion estimate for the fourth quarter, and then we said it will sort of trough at that level and then start to grow in the second half of the next year. And that's because of great performance by the team.
And what deposit costs are a factor there. They're rising. Looks like they were a little higher than expected and higher than competitors. Are you taking share, and where does that go?
Deposit costs are 150 basis points all in for $1.9 trillion of deposits, and deposits grew a little bit. So it's basically, and we have $500+ billion that are no interest bearing transactional accounts. So the deposit cost all in is really driven by the mix of deposits at a given moment. And at the end of the day, we have 1.9 trillion of those that represent our customers and clients' money that they're using to conduct their daily business. The money that was on the investment side, that's more investment oriented, has moved into the markets, and that you can see happen in our wealth management business over the last several quarters, but it's stabilized now. And so our deposit costs are derivative of the makeup. And in consumer, where you really have your good core transaction accounts, the all-in cost of 34 basis points, which is a very strong deposit cost given the transactional nature of that business.
And what is happening, Brian, with the consumer? We got a surprisingly strong retail sales report. You, in the past year, have been sort of leading the message about the strength in the consumer, which has been true. But is it fading? What's happening here?
Well, the retail sales number came out stronger, and sometimes that bounces around. But if you focus on what we see, so in a given year, we'll have $4 trillion plus of our consumers moving money out of their accounts to do something, using a debit, credit card, writing a check, taking cash out and spending it, sending money with Zelle, et cetera. So $4 trillion plus a year. In 2021, that grew over to 2022. Growth rate was 10%, 9 to 10%. In the early part of this year, 23 first quarter over last year's first quarter, sort of say 9%. It's now down to 4%, a little over 4 to 4.5%. That is held true in the month of September and also in October. That growth rate, to put it in context, is consistent with where we were in 16, 17, 18, 19, which was what? A low growth, low inflation economy. So the consumer's activity has slowed down. It moves around from which categories, but in the aggregate, across $4 trillion, 37 million checking customers, it's slowed by half. And that means the consumer is being slowed down by the interest rate environment and all the stuff going on. The good news is they're employed. And if you look in their accounts, you can see that they, in the median income households that have lower balance accounts, they're spending down that excess balance. It's still multiples of pre-pandemic. In the higher income households and higher balance households, they've already moved the money into the investment side. So, but you're seeing that deterioration of deposit balances in consumer in those median income households down a little bit. That means they're spending some money in excess of what they bring in. And so that means the economy is slowed down, consistent with a low growth, low inflation economy. I think that will play through the numbers. This is real-time data as opposed to lagging data, so we can see this every week. And the first 13 days of October look a lot like September, which is sort of 4%.